As the frequency and severity of natural disasters in Asia has increased, the risks to our buildings and infrastructure has amplified. The earthquake in Myanmar earlier this year led to the collapse of a building in Bangkok, but there have been numerous examples of extreme climate events across Asia this year, notably the super typhoon that hit both Taiwan and Hong Kong, a further typhoon that hit Vietnam and Laos, and the extreme flooding across southern China. Now, these events don't just bring structural damage, there are widespread consequences, including community disruption, bringing businesses to a standstill, and ultimately leading to significant financial losses. Now, another challenge is that for asset owners and developers is accessing sufficient insurance capacity at commercially reasonable terms. A crucial step to addressing these challenges is adopting a standardized approach to validating building resilience and developing a measurable benchmark. I'm delighted today to be joined by Ommid Saberi, Principal Industry Specialist for Green and Resilient Buildings at the International Finance Corporation, and Brendan Dunlea, Regional Head of Engineering and Property at QBE Asia. Welcome, gentlemen. We'll be discussing how taking a common approach to validating building resilience in Asia is so critical and how this can improve overall asset insurability. Ommid, the IFC has just launched the Building Resilience Index. Can you elaborate a little bit more on why this index was created and what issues the IFC is hoping to address with this tool?
Yes, Chris. So IFC is the private sector arm of the World Bank Group, and our aim is to improve the development impact in private sector in emerging markets. A lot of our work has been to support private sector development in construction sector, be it in housing, in offices, retail, hospitality. And all of these are creating economic activities as well as job creation for the market. We know that Asia has one of the largest protection gaps in the world. With this situation and increased number of climate catastrophes that are happening, we are seeing that impacts on the cities and buildings are growing and impacting the economic growth. We have seen in some island countries, a single disaster can wipe out 1 year of GDP of the country. In that situation, it's very important for us to come up with a solution to improve resilience of the assets. When we talk to our building owners, they normally say that they are complying with the building codes. And if we just rely on building codes, is that enough for resilience? And the answer is no, because building codes are either outdated or they are not being implemented in well enough. For insurance sector, building owners and investors, we need a solution to be able to measure resilience of the assets. Therefore, we came up with the Building Resilience Index program. Building Resilience Index program provides, number one, data on hazards. We are looking at 14 hazards category, and these 14 hazard category would have projections by 2050 and 2080. So the builders and building owners, they would have access to data on hazards. Once you have the data on hazards, the next level is that, okay, if I have flood in my building, what do I do? How do I improve my building for flood? So we need solutions, and those measures are provided within Building Resilience Index. We have around 100 solutions to improve the resilience of the assets. And these solutions come with the costs and benefit for each measure. Once the improvements are happened in a building, then it can be verified by a third party. So we have been working with Bureau Veritas and RENA to verify these claims by the clients. When we have the third party verification, that gives insurance sector assurance that this is not a claim by the owner, but also it's been verified by a third party. So as investors and insurers, we would have better access to verified data on those asset improvements. For example, if I give you an example of a hotel owner building 2 hotels exactly with the same specifications, same design in 2 locations. One can be a coastal location, another one can be city center location. Two of these can be exposed to different types of hazards, and the damages would be different. Therefore, from insurance or owner point of view, they may not see the difference. But when you check the same asset with Building Resilience Index, you realize that you need to implement different measures for each of these hotels. And that's where the benefit comes of implementing Building Resilience Index and improving the resilience beyond the building codes. They can improve and reduce the losses, because at the end, what we need to make sure is that the assets are suffering less losses. And when there's less losses, obviously it benefits the insurance sector, it benefits the communities.
In fact, many of our clients are facing these similar challenges. Many clients are trying to understand what their true natural catastrophe exposures actually are, and really how these exposures are evolving with climate change. The other big challenge to overcome is action prioritization. When you've got all of these measures, which are the ones that you need to prioritize that will actually improve your building resilience and make your asset more insurable?
That's exactly true. And that the point in terms of action prioritization is very important, because in BRI, under the Building Resilience Index, we have measures, around 100 measures, but you don't have to take all 100 measures. There's a basic level of resilience that requires certain types of measures to be applied. But we also know that if you are providing the best solutions, for example, on the one category, let's say on the earthquake, but you are not protecting your building well enough under the fire, your building may stand a good earthquake situation, but not the fire situation. So having a basic resilience across 14 hazard category and understanding which measures, what is the cost of each measure, and what is the reduced loss for each measure is critical. And that's what Building Resilience Index brings to asset owners.
Thanks, Ommid. Brendan, great to have you here with us today. Do you share Ommid's observations?
Absolutely, Chris. So in many low-income regions, particularly those that are heavily sort of Nat Cat affected, they go through one disaster, they rebuild with their scarce resources, only for a few years later to be knocked down again. And of course, this cycle sort of hinders like meaningful sort of progress towards economic sort of growth and prosperity for these low-income regions.
So in these kind of situations, how would insurers typically respond in terms of coverage?
We've seen numerous headlines of, will insurers be able to cope with all these increasingly frequent and increasingly severe Nat Cat events? And you see it with some regions where Nat Cat limits are being introduced, so they're restricting coverage so they can provide some kind of capacity, for these Nat Cat affected regions. Now, the renewable segment is a very easy example. Over the last few years, there's been very big hail, flood losses. We're going to see windstorm losses that will come, and the capacity there is being pulled back. You see limits are being sort of introduced so that to ensure there's some kind of capacity available. So as we strive to build a more resilient and sustainable world, we've got to also confront the growing headwinds of resilience and protection gaps.
Brendan, it's interesting that you bring up the renewable sector, as this is one sector that is heavily reliant on international project financing. Now, we know one of the key hurdles for asset developers in natural catastrophe exposed regions is unlocking sufficient capital. How does the index help with this?
When you're in the financing sector, you realize that the investment officers in the bank, the ones that they deal with investment, they need to comply with so many requirements. There's ESG requirements, there are governance requirements. These investment officers, they are not engineers, they don't understand construction. And for them to identify what do they need to do to improve resilience is almost impossible. So what they may resort back to say, okay, if the building has building permit or They comply with the building codes, that's fine. But we know that that's not enough. So having a system that makes their life easier, rather than them saying that we need resilience for flood and cyclone and this and that, they can say we need buildings that have at least BRI, B-level verified assets. That makes it much easier for investment officers to enable that. The other thing is sustainability-linked financing. So we have been providing sustainability-linked financing or bonds to market. Now we can enable resilience bonds and resilience financing. And that's really interesting. And the way that it works is that there can be targets set to say, we will be providing you lower interest rate if you comply with this specific level of resilience in the asset. And that, again, by having building resilience index, enabling this process is much easier. Without building resilience index, again, it becomes very difficult for the sector to provide a specific target or requirement. But with this, we can enable resilience finance and resilience bonds that can then grow the market on resilience. The resilience finance can enable financing not only through IFC, but this can be a solution that can be applied by commercial banks, by multilateral banks, by different entities that they provide investment and financing to this sector. It also can be deployed by large pension funds or other investors that they are providing capital for the markets. And with this, then we can have a major change in the market when it comes to resilience.
Ommid, I think that's a fantastic overview of how the tool is intended to respond and benefit clients and stakeholders of assets alike. Now let's go back to the genesis of the tool a bit more. I'd love to get both of your take on the partnership between IFC, QBE and Marsh. What do you think has made this partnership so strong in developing the index?
With the many seminars that we've had this year, and of course of which Marsh has been a key partner for us, a common theme, or if you like, a catchphrase has been, if it's not insurable, it's not bankable, which basically means that you need to have a good insurance proposition to ensure that you get the necessary finance for a project. We haven't had a good definition for our industry as to what is and what isn't a resilient risk. And this is a key element of why QBE and Marsh are working with the IFC and the BRI tool. So we believe it can give a neutral benchmark for the insurance industry, and not just the insurance industry, the building industry, the banking industry, design industry, as to what is and what isn't a resilient risk. And it's a neutral benchmark as well. If we don't have a target, then where do we aim for resilience? When we have a lot more entities adopting the BRI tool, the opportunity for resilience is really going to sort of take off.
I think this collaboration brings a fundamental benefit to the market, and the fundamental benefit comes from bringing innovation to building sector, innovation on improving resilience, something that has not been done before. And with Marsh extensive experience in risk engineering and understanding the risk, and with QBE's leadership, what we are showing in this collaboration is that how can we bring other parties to the game as well? Engineering, governments, investors. At IFC, we have been working with financial institutions, for example, with local banks to provide better financing, what we call it sustainability-linked financing. Our hope is that we can bring also resilience-linked financing along with insurance for the assets to improve themselves, or for the new builders to build more resilient assets. This would benefit the builders, this would benefit the insurance sector, this will benefit the investors, and at the end, communities and end users. We also want to invite different players, as Brendan mentioned, different clients to come and pilot these projects with us. We are already starting to do a few pilots in Asia, And we are hoping that these pilots continue to grow and bring assurance to the clients that this is not a play for us to act on single asset or two assets, but it's a market solution to improve the resilience of all assets across the region.
I couldn't agree more, Ommid, and it's been a great partnership. I think just listening to what you guys are saying, whilst the tool has an insurability angle to it, it goes far beyond insurance. And really, to the point you made, Ommid, on the output of the index, is this index can reveal much larger physical issues with assets. We've had a recent case of a client in Asia who's had repetitive water damage and flood losses coming from typhoon events. This was during their construction phase, and whilst that was an execution risk right then, their future risk is, would they actually be able to insure it from a natural catastrophe exposure? Now, in this case, Marsh were engaged to take a detailed assessment of the risk profile, and some of the recommendations that were put forward led to investments in engineered resilience. The client did benefit from having a much lower loss profile and continued access to broad form insurance coverage. But had they also had access to the index, it would have made the process much, much smoother. Risk could have been identified before project commencement. Justified resilience measures could have been enacted before any losses occurred, and ultimately, all parties could have saved a lot more money. Brendan, as the Building Resilience Index is going to be complementing QBE's underwriting approach, I assume this means that you're going to be leading all index-approved policies, especially from clients Marsh are representing?
Well, actually, Chris, that was something that was put forward to me by your colleague Ben Chang about a year ago. Asked me the same question. Rest assured that if they do good things with resilience, they should be rewarded. They should be recognized for that. They deserve to get something out of that. But also, we've got to look at the Marsh customers that aren't so resilient yet, and how we can sort of guide those to be more resilient. And of course, that they can get the benefit of better insurance coverage and lower premiums.
The last angle that I want to say here is that we have thousands of buildings in our cities, and these buildings, they need assessment, they need improvements, and that can create jobs for engineers and architects. They can go and assess the buildings using Building Resilience Index and provide solutions to improve, and those improvements can create jobs for small and medium enterprises. So this system can benefit across the value chain, from governments to financial institutions, to insurance, as well as to individual engineers and asset owners.
Thank you, Ommid, Brendan, for sharing your views. It's clear that collaboration across industry players and the development of innovative tools like the Building Resilience Index are vital in addressing risk transfer and financing gaps and helping to build a more climate-resilient infrastructure sector in Asia. Thanks for joining.